fine. No. Okay, I've turned on my record software. I'm going to go ahead and show the screen and remind us where the lectures are, because I received 2, if not 3 emails today asking where Tuesday's lecture is. So I'm doing show my desktop. Sliders are loaded. Starting that. You will see my screen in a moment. I assume that my voice is fine. I have it set on 100% right now. If you want me to turn it down, I can, if it's too loud. Okay. I'm opening up this would be my proxy server, but I'm on campus, so you would go to copy. I'm going to put it into the mega meeting chat room. Well, it doesn't like that. Copy this. Okay, everyone can see the address. I think most people should have this address. I'm putting the address into the chat box. You'll see it there. Okay. So the typical address is in plural, students, plural, students, .tjsl.edu. And then the lectures is /lectures, or you take your mouse button, your mouse cursor, you place it over the library, and the library opens up a menu of choices. The 2 important ones are class lectures and research databases. Normally you just use the proxy server and come directly into the research databases. For this one, I'm going into the lectures, which brings me to this page. I have to go down to step 1. Generally, IT has told us what courses have already been updated here on the screen. So, by example, I was asked about the tax treaty lecture from Tuesday. Well, it's here under ITP section, tax treaty 93008. It says it right there. So, for those of you in civil tax procedure, the 10308 civil tax procedure class is also already up. Larry Federer likes to tape his sometimes ahead of time. You have to contact the IT department by typing in help@tjsl.edu. Sometimes I mistakenly tell you to contact people at IT, but that just gets your emails ignored because they're not working that day. They're working on some project. If you send it to the help desk, they have people who man the help desk during all business hours, and the help desk is actually a physical help desk sitting in the IT office in the building next door to me. Students walk in there with their computers, and some students send emails from their home. So help@tjsl.edu. I have to choose the LLM program. For the tax treaties class that people were asking me about, I need to choose ITP, which stands for International Tax Planning. And then I have to select the class, which is down here at the bottom. And upon selecting the class, voila, it opens up. There's our 2-hour class from Tuesday, record on, which I will now close. Okay, so everyone understands where to get the tax treaty lecture. It's also posted, generally speaking, in the class where the lecture belongs to. I'm now going to go back to my proxy server and open up Tax Analysts, because we're going to continue to look at our second part of the sentence of Article 4 and our very slow and laborious dissection of its meaning. My lovely fiancé is here today at the office. Yes, they see you. Okay. I'm here under the model conventions. Model conventions brings me to the choice page of OECD, UN, and United States. I'm going to go ahead and click on the top one, the condensed version, and then click on the little arrows. I could click on the PDF and download the, I think it's 400-page PDF. I'm not going to do that. It will take too long to download. It's a pretty big file. And here I click on Article 4. Remember what I said on Tuesday, it's best to right-click, open in new window, and here we'll have our Article 4 on the screen. I'm going to put it on the side. Now on Monday we primarily looked at Article 4. Well, not primarily, we looked at Article 4 from the discussing what a person means in the context of the treaty. And to get to the concept of the person, we had to go to number 3, which I'll open in a new window. And so to understand Article 4's, open a new window. So I'm putting the articles side by side. To understand Article 4, which concerns resident, why was resident important? Because the treaty under Article 1 will apply to persons, a magic word that we want to seek to define, who are residents. So we have to define who is a resident to understand who the treaty actually applies to, and then people who are not residents, companies who are not residents, trusts who are not residents, partnerships who are not residents, and all the other kind of bodies of corporate persons or entities or relationships, as Don Riving calls them, inter se relations amongst members. All those other relations, they're not covered by the treaty. We did briefly look at the United States Treaty to see that the United States, from its model perspective, included the word, by example, trusts as a negotiation point in its treaties. Okay. We also said that we're not applying the 2 or the 3-step process examining treaties. We are looking at our more of a statutory construction, but they'll both bring us to the same outcome. Okay. Then we had to look at Article 3. So I'm going to draw some arrows here. The term residence in Article 1 gets defined in Article 4. We also have the term person in Article 4, which you of course see repeated in Article 1, where it says persons covered. And so where do I find the definition of persons? That brings me to my general definitions. The term person includes, and that's what we did Tuesday, an individual and so forth. That refreshes our memory. That's what we did. I will make that vanish now. We are now at the point of addressing under the laws of that state, the first part of the clause. So, under the laws of that state, is liable to tax, second part, 1. Is liable to tax by reason of, and then these are different criteria, but they all fall under the nexus of fiscal jurisdiction. That is, they all fall under the connecting factors test that allows a sovereign to impose its taxation, to exercise its jurisdiction over the person, however so defined. The term domicile must mean something, be different than the term resident, or it would not say domicile and then resident. Place of management, well, we briefly mentioned in our previous lectures central management control, effective management control, management and control, but we haven't really ever said the phrase place of management as a test, as the level of connecting factor that allows another country to establish, allows a sovereign to establish its fiscal jurisdiction over a subject of taxation. Subjects are over, by example, a company. Human beings don't usually have places of management. Human beings are generally tested on other connecting factors. Now, the people who are into logic, I'm not symbolic logic this time around, I said, but for those of you who watched last year's lectures, the ones that recorded, you'll see that I broke all the articles into symbolic logic. Anyway, in defining a term, as we did say on Tuesday too, it's somewhat tautologous, and I forgot what situation I was talking about, but here we have the tautology of, we're defining the term resident, saying that it's a person who by reason of his residence doesn't seem to be particularly helpful. However, these have two different meanings. Resident refers to the Article 1 term resident, meaning somebody who the sovereign can exercise fiscal jurisdiction over, whereas the term residence with the CE inside of this paragraph number 1 refers to the test of fiscal residency, the connecting factors test of fiscal residency, the nexus test of fiscal residency. We could continue with our sentence to where we find that a resident also includes that state, so it actually includes the sovereign. Why does it need to specifically state the sovereign? Because in many cases, the government itself is not subject to taxation by the government. Sometimes wholly owned government entities are themselves subject to taxation. By example, nationalized companies are generally subject to taxation. The government is just the shareholder. However, by example, the Federal Reserve, a government quasi-government entity, I do not believe the Federal Reserve submits a tax return. It is an organ established via the government. It is part of the United States federal system. Although, of course, in the United States, there are some people who dispute that. So it includes organs of the sovereign. It also includes and any political subdivisions or local authority thereof. Political subdivisions would be like the states and the state's organs. By example, the state of California's pension fund or local authority thereof. It could be the city of San Diego's pension fund investing in stocks in the Dutch stock exchange, or investing in an investment fund in Holland. Blackstone Capital, or if I'm recalling right, the Chinese government invested, I don't remember the figure off my head right now, I think it's $3 billion in Blackstone, via, if I recall correctly, the Dutch investment fund of Blackstone. And that allowed, I'm certain that the savvy Chinese sovereign funds, the sovereign investment, that is the government organ of China, which is probably not taxable in China, it's part of the government system, but it would be covered under the treaty if the treaty between Holland and the Netherlands followed the OECD model. It invests in the consideration of having the jurisdiction of Holland limited, at least in terms of the fiscal jurisdiction, limited or mitigated by the tax treaty. we're not going to cover today the second sentence of the first paragraph, which I mentioned on Tuesday. We'll cover that. Alan de Koker will cover that from South Africa, being this term does not include persons liable only in respect of source income. Okay, I'm going to clear away my little scribblings there. I'm going to make my Article 3 appear. I'm going to make my Article 1 disappear. And now we're going to expand our Article 4. Before I get to these test questions, domicile, residency, place of management, and other criteria, example, obviously it's missing the word incorporation. Let us see what the commentary has to say. And thus I will right-click on text of commentary so that we can have our two windows open next to each other. I'm going to do something by making my mega meeting window. Oh, look at that. Actually, I'm going to host options, video, none, Professor Byrnes, apply, minimize. Are there any questions about what we're doing with the tax treaty right now? As we go about deciphering this treaty? Low, go small. Oh, well, that's good enough. Are there any questions on the I don't see any. Not yet. Okay. Okay. So on the right side we have the article. We're going to the commentary. Now just be aware, in your asynchronous discussions with Alan de Koker, you should be discussing, because I set up the questions about ambulatory versus static approach of interpreting the treaty. Obviously everyone has now fully studied the two-step versus the three-step approach to actually interpreting a treaty from a public international law perspective. One does not generally apply this kind of statutory approach that I'm applying, though in the context of either the two or the three-step approach, it may be appropriate depending on the jurisdiction. We talked about the word shall versus may, shall equaling will and so forth on Tuesday already. General terminology that crosses boundaries of, I think, all jurisdictions. And so you're dealing with other aspects of understanding these articles in the asynchronous class. You're coming at it from a very different perspective. Remember that this series of lectures is meant to contextualize, as I started 4 weeks ago, to contextualize the understanding of this by comparing it to things that you do know as attorneys or as accountants. By example, using the statutory construction instead of the true public international law one is used in your asynchronous part of this class. So having made that disclaimer, we go from our resident article here to our commentary, and one of the questions in your asynchronous class is, which commentary do you apply? If my treaty is, pretend this was the Dutch-United States Treaty, and if the commentary is updated, I mean, the U.S. has its own technical explanations for its model treaty, But let's just say that the court did want to look at the OECD model. Canadian courts often look at the OECD model. In fact, most countries of the world often look at the OECD model. The United States is a little hesitant. Which model does one apply? The current model, as it's been amended for this year, meaning the commentary, the one that was in place at the time that the actual treaty was negotiated based upon that model and its commentary. So if the treaty was negotiated in 1992, does one apply the 1992 commentary to the treaty? Okay, so the question at hand is, the one I want to look at is, what does subject to taxation mean? Or is the actual language is liable to tax? Does that mean that, in particular for the U.S. purposes, does that mean that charities do not get to use the treaty? Well, remember in the United States that hospitals are charities, and that universities and law schools are charities in many cases, like Thomas Jefferson School of Law. It's a public benefit corporation for education. In many European countries, the universities are part of the government organ. But let's say that they're a independent corporation just owned by government that's not considered an organ. So like in the United States, they're considered an independent charity. Well, in looking at the commentary here, so that we get an idea of what all the countries have agreed to in drafting the Article 4 residency article and the language liable to tax. We first come to the third paragraph. I'm highlighting it. I'm just waiting for it to come up on your student screen. The third, it starts generally. Yes, it's highlighted now on your screen. We see the words impose a comprehensive liability to tax. So I told you probably last week about unlimited versus limited liability. Some people call it worldwide income taxation versus source taxation. Here we have the words comprehensive liability and full tax liability. Generally, the domestic laws of the various states impose a comprehensive liability to tax. That's generally true for the OECD members. Though not always true, France has a territorial system for taxation of its corporations. Not all countries in the world impose unlimited tax liability or comprehensive liability to tax. Many countries of the world use a source-based system of taxation, which is far simpler to administer, so say those countries. You have materials on that in your Principles of International Tax course. Okay. Now, full tax liability is imposed subject to the taxpayer's personal attachment. These are the connecting factors, the nexus. And this goes to the, and this rest of this paragraph goes to the connecting factors. So So after we understand from the top the general introduction of what this article is intending to accomplish in terms of relieving or mitigating double taxation between the two overlapping fiscal jurisdictions, the two sovereigns, we shoot down to specifically dealing with this first sentence, and we'll find it specifically addresses tax-exempt entities, i.e., by example, charities in the United States. So I'm going to highlight that portion. Okay, first we get, as we've already seen above, form the basis of comprehensive taxation, full liability to tax by personal attachment. Now, we see that diplomats, even though they may not be subject to tax at all, like charities, tax-exempt entities, even though they may not be subject to tax, that the commentary specifically says that they are deemed to be resident with full tax liability for purposes of this article. And not just diplomats, but other people in government service. And by example, United Nations persons in New York. They're in government service. Our 8.2, we get some exclusions, particular for conduit companies, and there's an OECD report on conduit companies. We get our second sentence description. And then finally, down at 8.5, we get to the crux of our question, of our issue right now, refers to persons who are liable to tax. So I've highlighted that for you. Now, I'm using, by example, the charity situation. So, in many states, a person is considered liable to comprehensive taxation even if the contracting state does not in fact impose tax. So, this starts to address my United States tax exempt scenario, or as we see also, for example, pension funds, which I mentioned already, like California pension funds, charities, which I'm specifically talking about right now, and other organizations that may be exempted from tax, like the Bar Association, the ABA. That's still falls under charity in the U.S., but a membership, I call it the charity rules, but really it falls under the tax-exempt organization rules, correctly stated. And the Red Cross. Okay. And then it does a caveat, but they are exempt only if they meet all the requirements for exemption specified in the tax laws. So again, in many states, a person, what is a person? A person is what we've already looked at in our general definition, Article 3. It's considered liable to tax, to comprehensive tax and limited tax liability, even when it's actually not subject to tax. So this article says it's a legal fiction. We consider you subject to tax even though you're not subject to tax. Now, one argument is with like charities, well, they are subject to tax, but under the domestic law, because they meet certain criteria, and that's where that next part of the sentences are getting at, because they meet certain criteria, they do not have to pay tax. They are subject to the tax jurisdiction of the sovereign, but the sovereign chooses not to levy tax upon them. So that argument is more similar to, by example, Holland has sovereign jurisdiction to levy tax from a jurisdictional perspective, to levy tax upon interest that comes from Dutch sources. It can get its hands on it because a payor from Holland, a payor of interest from Holland to a foreign party, the payor in Holland has physical control over the payment, over the money. And that payor can, on behalf of the foreign party, pay the final tax, the withholding tax, to the Dutch fisc, to the Dutch government, the Dutch Revenue Service, a Belastingdienst. So the Parliament has chosen not to exercise its levying power, which it could exercise, but it's chosen not to. It does not impose a withholding tax upon interest paid by a Dutch resident in control of Dutch source interest when it's paid to the foreigner. It just doesn't tax it. So there's no withholding. As a result, nobody pays withholding tax or interest in Holland when paid outside the country. That is an example of the argument that this commentary paragraph 8.5 is getting at, if you don't understand the language. Now 8.6 says, in some states, because remember the commentary is an amalgamation, it's not meant to create law, it's simply codifying, it's recording the comparative aspects of the tax laws of the OECD members. And now it's starting to pay respect to the observers such as the BRIC countries, India, China, Brazil, Russia. So in 8.6 we see that in some states these entities are not considered liable to tax. So some states consider them liable to tax, but from the vantage point of exemption, they do not levy tax upon them. Whereas in other states, they're just not considered liable to tax at all. In the United States, to contextualize that, is the state pension fund of California liable to tax? Can the United States exercise jurisdiction on it, or is it totally exempt? I think the United States can exercise jurisdiction, but sometimes I can't think of a situation, maybe somebody can put one in the chat room, where the United States actually doesn't have... Indian tribes is now that I'm thinking about it. Indian tribes. I don't know how they're dealt with in tax treaties. I know that they're covered, but I think our federal law and perhaps the Constitution, I'm not an expert on the Indigenous Peoples of America laws, but I think that they are actually, they're not exempt from tax in that the U.S. can exercise jurisdiction and chooses not to levy. I think that they are treated as sovereign nations, that the U.S. does not have fiscal jurisdiction over them, so you never get to the question of levy tax. I think that's how it is. So Petra says, what will be the case if I live in South Africa and I win one of the lottos in the USA? Will I pay tax to the U.S. on the winnings? So the question is twofold. One, does the United States exercise jurisdiction to tax on, what's threefold? Does it exercise tax upon that category of income? Winnings, prizes. One. Two, does that category of income, is it sourced in the United States that the government can exercise jurisdiction, assuming you're not a resident, that it can exercise jurisdiction over it? So, does the U.S. Exercise taxation upon that type of income? By example, with scholarships, we do not. At least in certain circumstances, sometimes we do. Number two, is it from a source in the United States? And finally, number three, if we do exercise, and there is a source in the United States, do we actually levy tax on that type of income paid to non-residents, to foreigners? Sometimes the answer to those questions are yes, yes, no. Example, portfolio interest. In the United States, we, as a category of income, we tax interest. Number two, is the portfolio interest from a U.S. source? Clearly, it's being paid from a U.S. company. But number three, the United States chooses not to levy the tax in its laws when paid to a foreigner, to encourage foreigners to make loans via portfolio interest loans to the United States. And then you say, will I have to pay tax to the U.S. on the winnings, or will it be the same in South Africa, where you are not, where you are only charged tax on the interest earned on the winnings, but not on the winnings? Well, the United States taxes prizes and so forth, like gambling and lottos. In the United States, that would be from a U.S. source, I'm assuming. And thus, and the United States exercises its privilege of levy on those winnings from a U.S. source. So, absent some special exception I don't know about for lottos, I don't think there's one, you would be subject to withholding tax in the United States, which you wouldn't pay because you're out to the U.S. You would, the payor, the lottery, would withhold it, and then if you had a claim that it should not be withheld upon under the tax treaty or something, well, in that case, you could make your claim by filing to get your money back with a treaty privilege. Now, I haven't looked at the South African USA tax treaty in a while, but under the treaty you would look to see if lotto winnings were covered. And although it's not the subject of today's lecture, certainly if lotto winnings are not covered by the articles dealing with substantive income, that's after your definition articles, so anything after Article 5 in your OECD model, then you get to the model that's the catch-all article, which states, flipping quickly over to the tax analysts web service, ding, we get to Article 21 of income. That is, income not included in Articles 6 through 20. And assuming it's not capital, 22. So Article 21, and however that article gets negotiated in the treaty is will find your result. But that's the analysis. 1, 2, 3. Do we tax the category of income? Is it from a U.S. source or from a source of that country? And number 3, does that country levy? If so, then we go to the treaty question. Is that type of income, that category of income, does it fall into our Articles 6 through? And if it does, now we have an idea of how those two countries negotiated the outcome of fiscal jurisdiction and levying on that category of income. If it does not fall in one of those articles, we go to the other income article, and we find the catch-all final solution of how the two countries have agreed to divvy up the fiscal jurisdiction. And then finally, the levying. If there is tax to be levied, has it been mitigated? So in like our Article 10, have we mitigated, minimized the tax that may be charged on dividends, as we looked at briefly last week. Okay. You're welcome. Now, 8.7, which goes back to our discussion on Tuesday, addresses partnerships and fiscal transparency. And there's also a OECD report on this issue dealing with partnerships. I want to draw your attention to other materials that will help you understand, perhaps help you understand Article 4, besides looking at articles and so forth. Well, you have your course materials, certainly, so obviously read your course materials. However, just to make sure we're all on the same page, I think you'll also find it helpful, besides looking at your course materials, to go to your proxy server, and in our research databases we're going to choose CCH. We're going to enter, click on the International Tax tab, Tax Treaties and Analysis. So we'll find it particularly helpful to look at FOGL and double tax conventions. And we click on our Chapter 2 definitions, residency, and regarding the first paragraph of Article 4. And the explanations herein that describe that, and then you have, which we'll go into right now briefly, the terms of domicile versus residence, management versus incorporation, and statutory seat or real seat. So I'm just pointing this out as important that should help you understand the next part of this article to be looked at. So I'm going to minimize my CCH screen, put it over my commentary for a moment. Since I have a career services lecture at 10 o'clock, we're not going to spend a full 2 hours going over this today, but for the part of the by reason of domicile, resident, place of management, and other criteria of a similar nature, for this part of the treaty, for this clause of this this sentence. You have your, I believe it's chapter 6 in your treaty materials, and written by myself and John Avery Jones. And you have here in Fogel the discussion of the German with cases, and we saw in our 4 weeks ago on how to find those cases. And we see the British law, domicile as opposed to residence as a particular application. And we see the German terminology. We spoke about the difference in language, words, definitions, and so forth in our first week also. We see the different words employed. And we see the description of that case. I'm continuing down because then we have the French term domicile, or closely being comparable to German terms. Then we get the contrast with common law, which goes back to obviously the English. And we have articles, which you can go through on your materials. There's a discussion of the Byrnes case, which you have in your materials. We discussed that in the classes. And we provide the case, but you can pull the case from your databases and so on. So I am pointing you to certain aspects of the book that will help you to expand upon your understanding. Then we have the USA, and the description of the US and what it's done, followed of course by our neighbor Canada. And the U.S. uses nationality as a criteria for, that is citizenship, as a criteria for taxation of her citizens, as in myself. So now where I am in the world, I must file a U.S. tax return. Okay. After that, we get into the second sentence, which is a discussion next week. So, to understand domicile, residence, place of management, yada yada, other terms, incorporation, we need to know what criteria, or if it's singular, criterion, like in the United States, corporations are tax resident in the United States based on a single criterion if they're incorporated in one of the U.S. states. They're U.S. taxable. There's not other criteria such as management control, real seat, and so forth. Management control, real seat, and so forth we go through extensively in the international tax course, the Introduction to International Tax Planning, which I also refer to as Principles of International Tax. So you get plenty of deciphering of the connecting factors, analysis of their application and so forth based on many different countries. It will be helpful for those of you not in the tax treaty, in the international tax course, to look at the IFA-CAIE on the subject of some years ago. So the IFA-CAIE, I'm going to put this in the chat box, to look at the IFA-CAIE on residency. You can find those IFA cahiers on the IBFD website. You can also look at the IFA website to get the years. They date back to 1938, and they do 2 cahiers a year on one subject, and it's usually somewhere between 50 and 80 countries. Their systems, as relates to that one subject, are described. And they're described in the exact same format, generally speaking, as close as can be, as each other country, so you could do a quick comparative analysis from one country to another. Generally, it's a lot of professors, one from each country or 2, or a well-known practitioner from a country, and then over the whole cahier, over the whole issue, cahier just means study, over the whole study, you have one general reporter who reads all the underlying reports and then pulls the comparative information from them so that you can see how the countries generally act and some notable exceptions. So you'd want to look at the cahier on residency, and you could see generally how all the countries treat it. We saw the first week of class, we looked at, I think it was the Netherlands, using our B&A source materials, but we contrasted it using against the IBFD, against CCH, against Checkpoint, and we looked at from many different ways to source what criterion or criteria a country applies with. And then the first time of the class 4 weeks ago or 5 weeks ago, we looked at also looking at case law analysis, so that though we had the actual law and a description, a treatise aspect of the law, we could also go and look how the courts have applied those criteria to a person being natural person, corporation, and so forth. Do that research on your own. As a subsidiary personal assignment, I would suggest you choose a few countries that you do not have familiarity with. Germany, by example, Israel, or the big trading countries like Brazil, Russia, India, China, and use your resource databases to find out what their criterion or criteria are, to see that you can find it. Do this self-assessment test for yourself. Can you find their criteria? And if you can you find analysis documents that illustrate how the Revenue Authority applies these criteria to specific persons, whether it be natural person or a corporation or a trust, if they have trusts, or a pension fund. I think you'll find that very helpful exercise. Okay. As I said on Tuesday, the purpose of today was just to look at the liable to tax, which I've pulled us into on using the commentary and briefly there on Fogel. Are there any questions? I have the announcement. Remember that at 10 o'clock my time, 1 o'clock New York time, for the career services, if you're interested, there is on the public calendar how you register for that webinar. I've written lots of it's an interview, so I have all these interview notes that I've sent in, and being the bills last night and the bill on Sunday or Sunday, and so I'm up to date on what's going on. I'm going to refresh my Wall Street Journal screen, and I think that interview lasts for an hour or hour and a half. It's at 10 o'clock, I think. I'm going to open up the public calendar on my screen. You'll see it as I see it. It's on a Speaking of Taxes website. I don't. Let's see. Okay. Here's the event on your calendar. It'll be on your screen in a moment. The current state of the financial services industry. And it's free. It's free because I've invited all of our career service students. I don't know, generally on these webinars they get something like 300, 500 people listening like it's a conference call. This actually was set up before the crisis that started last week with the collapse of, or amalgamation, or however you want to look at it, of several banks. And so it's become obviously more interesting for a lot of people, and so they have a lot of registration for this interview. Okay, anyway, I'm just making that known to you. If there's no questions, I'm going to log off so that I can drink the rest of my coffee here before that interview, so that I'm very awake, and eat my breakfast. Okay. Any questions? I don't see any questions. I'll stop sending my screen. Let's see, I have so many screens open. Let's see. Stop. Duck. Okay, I've stopped sending my screen. Auto apply. Okay, I don't see any questions, so we're going to log off on this side. Thank you, everybody, for joining us, and the lecture will be up by tomorrow.